Mr. Borges, thank you so much for joining us here on Bloomberg TV. Now, on the IMF's new economic outlook, what surprised you the most about this new outlook?
Well, it's not a surprise anymore, but we were certainly unhappy with the rapid decline in the pace of economic growth that has taken place throughout the world, but especially in Europe, because this is our focus. Europe had started the year very, very well. The European economy in general is a solid economy, balanced with low inflation and public finances under control on average. And so the fact that there is this rapid decline is certainly of great concern. In particular because every time that there is a slowdown, there is always the risk that we might fall into recession. This is not our base scenario, but we cannot rule it out.
And is it difficult to pinpoint exactly what factors are contributing to Europe's slowdown? There's, of course, a European debt crisis, but it's also a worsening of global conditions across the globe.
You're right. What has happened over the summer has had a lot of influence in Europe. There is a slowdown in world trade, which is, of course, of great concern. As you know, many European economies, starting with Germany, are very dependent on trade, and that has an impact. The situation in the United States is very concerning. This policy paralysis is, of course, contributes to the uncertainty that exists everywhere. And both of these, of course, have had an impact in the European economy. On the other hand, it is clear that the European sovereign debt crisis also adds uncertainty. But I would consider that one of the most important factors is that investors worldwide have become more risk averse over the summer and have moved away from any kind of asset that represents a certain degree of risk, and there's been a move towards the so-called flight to quality, which has had a very big impact on Europe, on European banks, and on the economy in general.
And also on the perception, because it seems that actually the crisis is now spreading to more domestic demand. So what was before limited to the periphery, now it's really touching core Europe and core countries, consumers, bankers and investors.
Well, the crisis is now at the core of Europe, no doubt about that. Part of it is this flight to quality. The fact that countries that were attracting a lot of investment in the past, such as Spain or Italy, now have more difficulty in placing their bonds in the markets. I think to a very large extent this is because of a change in market sentiment, which has now become more negative with respect to these economies. But of course the whole debate about the level of uncertainty in Europe also must have some impact on consumer perceptions and investor perceptions, which may have a downward effect on the overall economic activity.
You also mentioned the banks. Is there a real concern that actually funding could dry up, therefore jeopardizing the whole financial system in Europe?
Well, this is already happening. Banks in Europe, throughout Europe actually, are going through a difficult phase because, as I said, investors are becoming more reluctant, and even good banks, solid banks, well-managed banks now find themselves in some difficulty in the markets. The European Central Bank is offering to provide all the liquidity that the market needs, but for some reason this is not sufficient to restore confidence, and we have, as you know, a certain degree of concern about the banking sector. It is imperative that we restore confidence as soon as possible.
But funding is drying up, but are we actually risking a Lehman Brothers type effect? Are we actually risking the money markets to be in complete mayhem? And what can governments and what do governments need to do now to avoid that?
Well, the most immediate risk is that credit will be cut. As banks face a certain level of difficulties, they will reduce their balance sheets. They'll cut back on their on credit. They will sell assets and so forth. And this by itself is already very damaging for an economy that's slowing down. So that would be our immediate concern. More serious concerns, a Lehman-like scenario, I think are not yet likely to happen. But of course, we must be very much aware that we have to avoid them at all costs.
How do you actually stop the fear in the markets that we were talking about in this kind of situation? What's the IMF's preferred solution? Do we need an increased EFSF? Do we need more solidarity? Do we need more leadership? What kind of timetable would you be looking at to make sure that there is coordinated action as soon as possible to avoid the next step of the crisis?
Well, you said already quite a few very important things. Number one, we don't have much time, so we need to act relatively quickly. because otherwise the decline in economic activity could become more pronounced, and that would have very serious consequences. Number two, we need coordinated action. It cannot be isolated country by country. It should be a European approach to these problems. And number three, we need action on several different fronts at the same time. We need stronger banks, and something needs to be done to achieve that goal, bringing more capital into the banking system. We need to restore confidence in the debt markets, to create conditions under which the investors will be convinced to come back to the debt markets. And we also need a reinforcement of discipline, of fiscal discipline in all countries, so that every one of these factors contributes together to a different overall situation that restores, let's say, normalcy in the markets.
But so how quickly, to go back to this normal scene in the markets, how quickly do we need to make sure the markets understand exactly how much of a hit private creditors will take in the event of a default of Greece? And should we start working on a Greek default right now instead of pushing it back to see if something happens in the meantime? Because, leadership is lacking.
Nobody's talking about the Greek default right now. I think we're all working very hard to get the Greek economy back on track. There is a team in Athens working with the government very, very hard. There's a plan in place, which is the one that was defined in July, and under which the various European countries stand behind Greece to maintain the economy on the right track. It is very important that the Greek government and the Greeks in general do their part, and that's what's being discussed and negotiated at this point. It may take longer than what we initially thought, but we are convinced it will happen. That's the current situation. In terms of private sector involvement, meaning what kind of haircut investors may have, there is a plan in place. It may need to be adjusted here and there because conditions are not exactly the same, but for the time being, it's our plan.
And in terms of inflation, that's declining. So does it mean that actually central banks will have more ammunition to support the economy? And if they don't, if they're unwilling to do so, what can the IMF do to step in and stop the crisis from, again, just entering a new phase?
Well, you're quite right that we're much, much less concerned, or not concerned at all at this point, about inflation. Although some inflation figures, some headline inflation figures may still look high, they're all due to very, very short-term effects, and core inflation is very low. There are no inflationary pressures at all in all markets, including wages and so forth. So we don't have any concern about inflation at the moment. And I believe that's also the view of the monetary authorities. So our expectation is that central banks, and especially the European Central Bank, will have less concern with inflation, will be able to support the economy in a better way. Of course, we're talking essentially about Western Europe. In Central and Eastern Europe, the situation may be different, and there are countries where inflation is still a great concern, for example, in Turkey or in Russia. But in Western Europe, that's not the problem today, and we hope that that may lead to a change in monetary policy. It's already happening in certain parts of the world, and it would be most welcome in Europe. Now, the IMF cannot replace the central banks. We can step in to help in emergency situations, and we're ready to do so, as we've always been, but this is in no way comparable to what central banks can do in terms of monetary policy.
Antonio Borges, thank you so much for being with us.